Cash, despite the fact that I believe the higher deposit rates that we're enjoying are still below the real rate of inflation, I think you have to have cash because cash gives you the tools and I hope the courage that if we have a liquidity-driven market squeeze, that investors can take advantage of that squeeze rather than being taken advantage of by it.
Financial expert Rick Rule offers a thorough examination of the evolving global economic landscape, emphasizing the need for investors to remain vigilant in the face of changing market dynamics. Rule underscores the importance of heeding Jamie Dimon's perspective, stressing the necessity of adaptability given Dimon's impressive track record. Rule points to the conclusion of a 40-year period of relative stability, attributing this shift to escalating geopolitical tensions in regions such as the Middle East and Ukraine. He hints at an imminent increase in market volatility and suggests short-term investments in North American oil stocks as a strategic response. Additionally, Rule explores the complexities of the housing market, highlighting surging costs and a growing disparity between buyer and seller expectations. Amid this uncertainty, Rule advocates for diversified investments, specifically in assets like cash, gold, and uranium, known for their historical resilience during economic fluctuations. He underscores the importance of liquidity, empowering investors to capitalize on market squeezes rather than succumbing to them. A major concern raised by Rule is the global lack of sustaining capital investments in resource production. He predicts this shortage could lead to resource scarcity, subsequently driving raw material prices significantly higher over the next 5 to 6 years. This foresight serves as a warning to both investors and consumers, urging them to prepare for a future where resource availability may be limited.
When you get somebody that is much of a fulcrum, as much of a nexus as Jamie Dimon is, at the same time that you have somebody with his extraordinary track record of success in a seat of power, that you have to listen. You do have to listen. It's not as though we haven't faced challenges before. It's not as though we haven't lived through risky times before. But I suspect that what Jamie Dimon is referring to is the fact that we've gone through 40 very benign years, the sort of period, 1982 to 2022, and pretty clearly those times are over. If you put what's happening in the Middle East on top of what's happening in the Ukraine, on top of the geopolitical tensions that we're facing other places, clearly the next 10 years is going to require a lot more dexterity than the last 40 have. I think in the near term, particularly the North American oil stocks will probably outperform the markets, the mining markets. I need to say that the prognosis I just gave you about raw material shortage is a 5-year prognosis. If the world manages to sail into a worldwide recession, you can have lower supply if you have lower demand and the prices still don't move. The cap that we seem to see in the oil business and in the mining business, I think has to do with the specter of global recession, which is a very, very, very different topic. I'm not saying it's going to happen. I'm not saying it isn't going to happen. I'm a credit analyst. I'm not an economist. But I think if you are looking at the thesis of the sort of talk I just gave you, the fly in the ointment from an investor perspective is the specter of recession. Cash, despite the fact that I believe the higher deposit rates that we're enjoying are still below the real rate of inflation, I think you have to have cash because cash gives you the tools and I hope the courage that if we have a liquidity-driven market squeeze, that investors can take advantage of that squeeze rather than being taken advantage of by it. Uranium, for the reasons that you and I have been talking about for 3 years, we're using more of it than we're producing. And it's an important part of the ascent of humankind. Gold, because gold does well during periods of time when people are concerned about the maintenance of the purchasing power of their savings in conventional assets. So yes to cash, yes to gold, and yes to uranium. Affordability is very difficult. People, particularly younger people who are trying to get into their first home, are having difficulty saving the newly required down payments at the same time that their costs, not just their mortgage costs, but also their taxes are escalating. Builders are finding inflation throughout the value chain in terms of building new housing. Permitting and fees are going through the roof. Lumber is expensive. Labor, where it's available, is expensive. At the same time, the sellers of existing homes are hoping to get paid the prices, if they sell them, that they would have enjoyed 2 years ago. There seems to be an enormous gap between the bid and the ask. My suspicion is that if interest rates rise, then the gap will close to the downside, that some sellers will be forced to capitulate. Of course, there's a whole class of sellers that enjoy, and I think that's the right phrase, mortgages, long-term mortgages that they locked in 2 years ago or 3 years ago. Those people are in the wonderful position of having a liability, which is to say a mortgage that's really an asset as a consequence of the very, very, very low rent on their money. What I think you will see in the next two or 3 years is a dramatic decrease in new construction. And I think that'll be felt in a negative way, really throughout the economy. In the face of higher interest rates, the United States economy is truly a beast. I'm not trying to say that it's a beast that can continue to take abuse at the levels that we shovel at it, but I must say that the resilience of the United States economy has surprised me and pleased me greatly. It's interesting being at a Stansbury conference where, you know, the major theme seems to be the world ends on Wednesday and here's how you can profit. But the truth is that we do have an economy that has an awful lot of strengths, and those strengths have been evidenced in the last 2 years in very surprising fashion. What is certain about the circumstance that we're in today is that major resource-producing societies and major resource-consuming societies are not investing substantially in sustaining capital around natural resources, which will, in the future, make them more scarce. The Russians, as an example, have other things to do with their money. They're selling, much as they did in the early part of the 90s, anything that they can turn into cash, including commodities, driving commodity prices down. At the same time, the Russians aren't investing substantially in the sustaining capital investments that they need to maintain their own oil production, which means that 2 years from now, 3 years from now, 4 years from now, the Russians' ability to produce oil at the same level that they produce it today declines materially. The longer that they spend money in the Ukraine, and the longer that they starve their domestic oil industry, the more that their domestic oil industry becomes production capability constrained. We saw this happen in Venezuela. We saw this happen in Mexico. When you starve oil companies for sustaining capital investments, you impair their ability to produce, and you impair their ability to produce for a long time. And I'm not limiting this to Russia. We're seeing around the world a dearth of new project investment and a dearth of sustaining capital investment that will impact us as consumers of raw materials for a long time. I think that the probability around that lack of sustaining capital investment means that consumers and investors need to think about higher raw material prices, probably substantially higher raw material prices 5 to 6 years out. I realize that 5 to 6 years may be beyond the time frame of most investors, but that notwithstanding, that's something that people have to look forward to, if that's the right phrase.
In today's video, we delved into a thought-provoking discussion by financial expert Rick Rule. He highlighted the pivotal shift in the global economic landscape, emphasizing the need for adaptability amidst escalating geopolitical tensions. Rule stressed the significance of short-term investments in North American oil stocks and discussed the complexities of the housing market, predicting potential challenges due to rising costs. He advocated for diversified investments in cash, gold, and uranium, citing their historical resilience during economic fluctuations. Rule also raised concerns about the lack of sustaining capital investments globally, foreseeing potential resource scarcity and rising raw material prices in the next 5 to 6 years. As consumers and investors, it's crucial to prepare for these shifts, understanding the implications on our financial decisions. Stay informed, stay prepared, and make sound investment choices. Thanks for watching.